commercial real estate, but it has been very much in focus over the last couple of weeks. Now, a major owner of office properties, Brookfield, defaulted on a $161 million mortgage for a dozen office buildings, mostly around Washington, D.C. Right now, that stock is down about 0.75%. Listen, despite that bad news, our countdown closer says there is one real estate investment trust that's giving life to his portfolios. John Mowry manages $6.8 billion in assets under management as the CIO of NFG&J Investments Group. He is joining us now. All right, let's hear about this one and why you don't fear a commercial REIT having some problems when the world seems to be changing a bit when it comes to back to the office and back to work.
Great to see you again, Liz. So a couple things I'll say just high level about real estate. The time that you want to really consider looking at real estate is when capital is being turned off. And ironically, that's when you get the biggest dislocations. And you will get some weak players that do get kind of shuffled out in the mix. But Alexander Realty is a really unique office REIT. And that's because of its tenants. It actually caters to life science, pharmaceutical companies. And as a consequence of that, it has very high collection rates. And those folks aren't able to move offices as easily. If you think about a laboratory or anyone that's doing work in the life science field, you can't just up and move to another office building. So they have strategic locations around universities on the East and West Coast, and they have very stable FFO growth. And what you're seeing is a dislocation in the valuation with ARE, but not a dislocation in the fundamentals. So I think ARE is a really interesting way to look at the office REIT space. And ironically, this would screen as a more expensive office REIT, but I think that's because it's misunderstood. If you were to look at it with the appropriate peer group, you would see it's actually trading at one of the steepest discounts since 2008 as well as in 2020.
Yeah, I'm looking at the price to earnings ratio here. It's at about 39, which would look certainly rich. Stock is down about 36% year over year. But as we continue to watch the real estate investment trust world, you also have some other names that you say should be in people's portfolios right now. Let's put them up on the screen. And I particularly want to tackle PayPal. PayPal still has not recovered from its worst levels here. Give me about 30 seconds on PayPal.
Yeah, so it's interesting. PayPal got egregiously priced during COVID because everyone went to touchless payment software. So you had an egregious valuation. Now PayPal's trading at just 14 times earnings, the cheapest valuation on P basis we've seen since the IPO. What's interesting is you got PayPal even more discounted because of the banking crisis, because it does map to financials. But ironically, this is not a bank. And so I would argue that the dislocation that was further created from the regional bank catastrophes that have occurred have just created more of an opportunity for PayPal, because the majority of its revenues are from transactions, not from net interest margins.
John, thanks for coming on. We appreciate it. John Mowry. Hey, listen, tomorrow